Imagine walking into your favorite store and finding everything half price. Wouldn't you grab those deals immediately? That's exactly what's happening in the stock market right now, with these 5 quality companies trading at massive discounts. Companies like Wayfair and Adobe are trading at startling discounts, with values plummeting 28% and some dropping to 50% below fair value. Have you ever kicked yourself for missing an obvious bargain? These aren't failing businesses, they're temporary markdowns that savvy investors are quietly scooping up while others panic sell. So, how can these temporary markdowns be transformed into long-term gain? Ever wonder why Warren Buffett gets excited when markets drop 10%? While most people are panicking and hitting the sell button, billionaire investors are quietly loading up on quality stocks at fire sale prices. That's exactly the opportunity we're seeing right now in this market correction. The market has officially entered correction territory. Stocks are down more than 10% from their recent highs. AI stocks have taken an even bigger hit, with 15 to 20% drops in major tech names. Think of the market like a spring that's been compressed. All that pressure is building up for a rebound. This pain is creating a rare buying opportunity for smart investors. Historical data shows something fascinating. Purchasing quality stocks during downturns typically leads to gains of 20 to 30% within 12 to 24 months. While everyone else runs away, smart money moves toward these discounts. Imagine feeling that rush of triumph when your discounted purchases start climbing while others remain paralyzed by fear. This current sell-off is concentrated mainly in previously overvalued tech stocks that had massive runs last year. It's actually a healthy sign. The market is recalibrating rather than signaling a major economic disaster. Economic indicators like employment, consumer spending, and corporate profits remain relatively strong, suggesting we're experiencing a valuation reset, not a fundamental economic breakdown. Smart investors look for quality companies whose stock prices have dropped much harder than their business fundamentals have changed. Picture this. You've been eyeing a house, and suddenly the market drops 25% while the house itself remains unchanged. You'd consider that a buying opportunity, right? That's exactly what's happening with these stocks. A significant price drop despite minimal change in actual business performance. The average investor does exactly the wrong thing during corrections, buying high when excited and selling low when scared. This emotional cycle creates discounted opportunities for patient investors who recognize the disconnect between price and value. This is where our 5 promising stocks come into play. Each company, Wayfair, Adobe, Macerich, Marvell, and PG&E, has been caught in the market-wide sell-off despite having strong fundamentals. They're solid businesses with competitive advantages whose revenue streams haven't dried up, customer bases remain intact, and long-term growth prospects strong. Their stock prices have disconnected from their actual business performance, creating potential value opportunities for investors ready to act while others hesitate. The house example I just mentioned, that's exactly what's happening with Adobe and Marvell technology right now. While investors are panicking about AI disrupting these companies, they're actually transforming artificial intelligence into massive new revenue streams, all while their stocks sit at dramatic discounts of 24 to 33% below their fair values. Let's take a closer look at Adobe first. A tech giant with some of the most widely used creative software in the world is currently trading at a 33% discount from its intrinsic value of about $590 per share, with the stock dropping nearly 28% since mid-December. The market is selling Adobe because they're worried, I will make Creative Cloud obsolete. But look at reality. Adobe's AI initiatives like Firefly, GenStudio, and their Acrobat AI assistant are gaining serious traction. These AI products are already generating $125 million in annual recurring revenue, expected to double by the end of this year. This panic selling has created one of the clearest buying opportunities I've seen in 2023. Adobe maintains its wide economic moat because of the high switching costs associated with its software. As industry expert Mark Thompson recently noted, creative professionals who've invested years mastering Adobe's ecosystem simply can't afford the productivity hit of switching platforms. That protection gives Adobe time to integrate AI rather than being replaced by it. The valuation becomes even more compelling when you look at Adobe's forward PE ratios. As earnings grow, today's multiple of 23x will drop to 17x next year and potentially to 14x the following year. That rapid compression shows how quickly this valuation gap could close once the market realizes its mistake. Just as Adobe dominates the creative space with sticky customer relationships, Marvell Technology is positioning itself as a crucial player in AI infrastructure. Marvell is like a skilled architect working behind the scenes of the AI revolution, designing the foundations while others focus on the visible features. The semiconductor company has taken a beating, with shares down from January's peak of $126 to around $69, a 24% discount to its fair value of $90. What's fascinating about Marvell is how its business is evolving toward data center and AI segments, which are becoming dominant parts of its model. While other companies are still figuring out their AI strategy, Marvell is already positioned to benefit from the explosion in data center build-outs needed to support AI infrastructure. The math for Marvell's recovery is straightforward. Analysts project earnings to grow from about $3 per share this fiscal year to approximately $5 in following years. With a projected forward PE ratio around 14x, the upside becomes apparent as the market eventually recognizes the disconnect between price and value. Both companies demonstrate classic market overreaction. The market is pricing in worst-case scenarios while ignoring the actual business results these companies are delivering. While tech giants can be great bargains during market corrections, sometimes the real treasures are hiding in plain sight, in sectors most investors aren't even looking at right now. What if I told you that some of the most undervalued stocks on the market today have nothing to do with AI, semiconductors, or cloud computing? Instead, they're in furniture, shopping malls, and utilities, industries that might sound boring, but could deliver exciting returns. Hidden in the most unglamorous corners of the market, Wayfair stands out as an extreme bargain on our list. This online furniture retailer has dropped 28% this year alone and now trades at more than 50% below what analysts consider its fair value. Once a pandemic poster child for home decor, Wayfair is now poised for recovery as it streamlines operations. Wayfair got caught in a perfect storm. During the pandemic, everyone was stuck at home redecorating, and their sales exploded by 55% in 2020. But when the world reopened and supply chains got messy, growth couldn't continue. The market treated this temporary slowdown as a permanent business failure. Wayfair has been cutting costs and right-sizing operations for current market conditions. They've positioned themselves for significant margin improvements once sales growth returns. This market overreaction creates a genuine buying opportunity. Next is Macerich, a company reinventing leisure and lifestyle in an era dominated by digital shopping. This Class A mall operator offers a 4.1% dividend yield while trading at a 28% discount to fair value. The market treats mall operators like they're going extinct, but Macerich has been transforming their properties into experiential destinations. These aren't ordinary shopping malls. Macerich properties now feature restaurants, gyms, doctor offices, and movie theaters, experiences you can't get through online shopping. This diversification makes them far less dependent on traditional retail and more resilient against e-commerce competition. Finally, there's PG&E, a California utility company. While most utility stocks have been rising this year, PG&E has dropped 16%, creating a 12% discount to fair value. The market remains concerned about PG&E's previous wildfire liability issues, despite significant improvements. Think of California's Wildfire Fund as an emergency reserve that ensures utilities remain secure despite past challenges. This $21 billion safety net is specifically designed to protect utilities like Pacific Gas and Electric. Half is already funded in cash, with the remainder authorized for bond sales if needed. Analysts believe the state would expand bond authorization if necessary, because California has a vested interest in maintaining financially healthy utilities. Ready to uncover why these overlooked bargains might be the next big rebound? The window of opportunity rarely stays open long. The best time to buy is usually after initial panic. Selling has stabilized, but before the broader market recognizes the overreaction, exactly where we are now with these three stocks. Research shows these correction periods typically only last 3 to 6 months before stocks start recovering, so your window for these gains is closing fast. The smartest investors aren't sitting on the sidelines. They're actively hunting for quality companies while prices are artificially low. Imagine turning today's fear into tomorrow's fortune. That's the opportunity waiting for you right now. The biggest fortunes aren't made by timing the market perfectly. They're made by recognizing value when others are too afraid to act. Which of these discounted stocks will you seize before the market catches on? Wayfair's massive discount, Adobe or Marvell before tech rebounds, Macerich's juicy dividend yield, or PG&E's recovery potential? The opportunity is here today, but probably not tomorrow.